Hello, I'm Robin Gibson, and this is your Harvard House Money Morsel. Welcome back. Thank you for joining us again. Please don't forget to like and subscribe. Click the bell so that you can get a notification of when we release a new video. I'm sitting again with Michael Porter, Chief Investment Officer of Harvard House. Welcome, Michael.
Morning, Robin.
Michael, we've seen over the last little while, beginning of the year, there was a lot of fear about inflation, US interest rates, a lot of volatility in the market. But over the last 10 days, the markets seem to have steadied down and actually maintain a bit of an upward climb. Can you please tell us what's changed and what's going on?
Sure, Robin. First of all, it's a frosty morning in Howick this morning. So, I hope everybody's warm wherever they are. Robin, the first half of the year has been obviously characterized by enormous volatility in commodity prices. I'm sure every listener knows what's happened to our own petrol prices, 26 Rand a litre or wherever they got to, depending on where you are in the country. So oil prices, commodity prices, food prices, because of Russia, because of supply chain, everything like that. Now, some of those are normalizing. We know you said all the time that things don't go up in a straight line. Oil prices are down sort of 25% from their peak, $125, $130 a barrel. They're sort of sitting at 95, 97 at the moment. Wheat prices have come down because they're exporting wheat from Ukraine. Hopefully it'll last, but wheat prices are back to where they were. So basically what we saw last week was the US inflation number declining for the first time. So not that inflation is declining, that the rate of inflation has declined for the first time. So over the last year, 18 months, it's just been a steady climb upwards. We've gone from 2% inflation to, it peaked at 9.1% in the US. And last month's reading was 8.5% or 8.4%. It was much better than expected. And I think this is what we've been saying for 6 weeks now, is that US inflation in particular is rolling over. So inflation is really the rate of growth of prices year on year, And it doesn't mean to say that prices are going down. Don't get me wrong. It's not to say that things are going to collapse. But inflation is about the rate of growth of prices. And you can have 0% inflation, prices can just stay where they are. So now you can start comparing this year to last year and where oil prices are, and suddenly the difference is not as massive. So inflation is rolling over. That then takes the pressure off the Federal Reserve to raise interest rates as aggressively. Yes. So they're still going to raise interest rates over the rest of this year. They're not convinced that inflation is back in the bottle, and I would agree with them. So they're still going to raise interest rates, but people can start to see the end of the cycle and what lies beyond, and that's why markets have reacted. So the S&P, from its clients will know that May and June were particularly bad months for markets globally. The S&P, off its lows in the middle of June, is up 16 or 17%.
Wow.
The FTSE index is actually up year on year, but that's partly a currency issue. So I think in some ways you do have to distinguish between the US and Europe, Robin. Europe's got some problems. I mean, the terrible drought that I'm sure everybody sees on the news is devastating Europe. It's pushing up transport costs because they use a lot of their rivers to transport things. And there's still gas wars with Russia. Gas prices are soaring again at the moment. And so Europe is quite a few months behind where the US is. Yes. But the US reacted much more quickly and much more aggressively in the first place, which is why the dollar was so strong. But if US interest rates, if the trajectory of US interest rates starts to change or starts to soften, that is a huge release for the whole world, because it affects emerging markets, it affects emerging market currencies. US interest rates is sort of the center pivot on which everything else hinges. So it's a crucial foundation in what we think about.
So, Michael, we had in our interview with Vili a couple of weeks back, we talked about when our local Reserve Bank raised by 75 basis points, that was a very aggressive, it was almost a hard stamp on the brake. America's done pretty much the same thing. and Willie said we would benefit from that early action. Is that to some extent what is happening?
Yeah, exactly. So America went out hard. Initially, they did a couple of small adjustments, and then they realized that they were behind the curve, and they came out with a sort of 50 basis point and then 275 basis point hikes. To put it in context, the America hasn't hiked rates by 0.75% probably since the 90s or the 80s. So it really is going back a long time. And so yes, that early action, that aggressive action, has convinced people that the Fed is sort of on top of it and that inflation is sort of rolling over. And listen, obviously commodity prices and some recessionary fears and a slightly weaker economy out of China, all helping to dampen commodity demand and bring some things back to normal. So I'm not saying that inflation is is not an issue anymore, but that real excessive runaway inflation appears, certainly in the US, appears to be rolling over. So it's something to watch. I mean, markets are going to be volatile for sure, but certainly there is light at the end of the tunnel. And then, added together over the last couple of weeks, you've had US companies reporting, and the reporting has been, I think, a lot better than what people expected. The economy is more resilient than what people expect. So together, those have just created a nice environment for stocks to rally.
Awesome. Well, Michael, thank you for coming and giving us some insight into what's happening. It's really helpful to hear the color behind it. Please don't forget to like and subscribe and join us next time. Thank you.
Thanks, Robin.